Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The story of this market has been the story of three channels. That is changing. Originally, it was a mid-June to early September shallow bear channel held up in late August at the important 38.2% absolute Fibonacci support below at 521, which ignited the bullish incentive enough to push up and out of the bear channel. The subsequent early September to mid-October bull channel that peaked with a V-top formation early to mid-October, and the most recent example, a dark blue highlighted mid-September to date bear channel that has been finessed a little and which I acknowledge looks like it was possibly morphing into a descending, expanding wedge pattern, especially with prices forming an extension to the V-top over the end of October and the start of November. I said these things were changing, and so they have, as prices have sauntered sideways out of this bear channel along the very shallowly bearish bright red neckline currently at 559 of the February to April reverse head and shoulders pattern, a bottom in fact. On a few occasions during November and December, the market breached and tried breaking down through the bright red neckline extension, but has failed to stabilize below it. However, the congestion at 545 from March and August, as well as the September 2020 low at 540, have interfered with this, especially on a closing basis. I suspect the 38.2% absolute Fibonacci line at 521 might also be influencing this as well. Meanwhile, overhead this week, the December 2020 low at 566 has capped prices, but also keep an eye on the fairly flatlining medium moving average overhead currently at 576 as a resistance, as well as further up the declining short medium moving average currently at 583 and the flatlining long moving average currently 589. Now, what I suspect may be taking over and the running here on this market for at least a little while now, and arguably has done since early October, is a pattern I drew last week, a late May to early October bearish shift pitchfork. The market right now is in between the overhead upper time currently at 583 and the middle time below currently at 509. Now, the final thing to note is something I mentioned before, and that is 5 Fridays ago the combination of the short moving average currently at 558, the short medium moving average currently at 583, and the very slowly declining long moving average currently 589. All of them together made a bow tie formation. Now, I'm the first to say that it was not a great bow tie formation, as the moving averages were in the wrong order, but that being said, it looked like a bow tie formation. Therefore, I suggest to look to the immediate direction of the moving averages, which was principally lower, to show some guidance on the market, which we have seen. Plus, look out for volatility between 15 to 20 sessions after the crossover. So that was between the 29th of November to the 6th of December. And to be honest, there wasn't that much of a show of volatility. However, the day after the 6th of December, that is Monday the 9th of December, the market did exit out of the dark blue bear channel, the main run of this market since mid-October. So I guess there was something there after all, just not very expressive. Chicago corn. The green short medium moving average, currently at 435, had previously showed a significant support to this market back in mid-October, halting decline and starting after initially being capped by the gold long moving average, currently at 432, and conversely being held up and helped higher by the 50% absolute Fibonacci line at 425. started a mid-October to end November bull channel. Now, 5 weeks ago I asked the following, and I quote, "The key question will be whether prices can attain the early October highs between 450 and 455, or will the erosion of the bullish incentive by, for example, the gold long moving average or the November 2020 high at 439, whether these will be enough to prevent prices from trading higher." End of quote. Well, the 450 to 455 area topside has indeed capped the topside once without even being tested, and prices did for a while staircase a dance of 2 steps down followed by 1 step up, etc. In more recent times, the last 2 weeks specifically, the green short medium moving average and the gold long moving average have become supportive, but not to the level of earlier efforts, as prices did end up exiting the bull channel on the downside 3 weeks ago. Though truth be told, the 2 moving averages and the 50% absolute Fibonacci line at 425 did turn prices higher, enough that this week the market challenged the broken bull channel, but from the underside, though now effectively. You see, from Tuesday to yesterday, the market made a 3-day bearish evening doji star pattern. That's a big bullish move, a star, and another bearish move, that way round. With in the middle of that, a shooting star pattern. That's the type 1 bearish. And you can also be seen as a possible gravestone doji, enough that for now it looks like the market may have peaked. It all now depends on how good the supports remain from the November 2020 high and the 2 moving averages. I'll now refer you to my words from 3 weeks ago when I said, and I quote, "I fully expect to see further pressure on the downside and even the development of an October to date bearish flag stroke halfway hesitation pattern. But nothing like this has happened. Sure, we are below the recent lower bull channel line, seemingly trailing along the underside of it, but we are still above the gold long moving average, which only had a single close below it, and well over the green short medium moving average and the 50% absolute Fibonacci line as well. To me, this means that the recent bull channel is not the dominant pattern here, that another pattern is developing in the next few days, and I will have to finesse this pattern or retire it completely. All very interesting." End of quote. Last week I thought that might be the new mid-May to early October bearish shift picture, but it wasn't, and I've retired this pattern as well. And I draw your attention to the possibility of the October to date action being a possible triple top or even an ascending triangle. Now, I haven't drawn these in as yet, but I'm thinking about them very deeply. Kansas City week. Much like Chicago week, this market had been the story of 3 channels. The oldest and arguably the longest was the late June to early September shallow bear channel that eventually ended up with a spike down flattened V bottom at the end of August. Secondly, there was the late August to mid-October bull channel that was eroded by both the slowly declining long moving average currently at 598 and the medium moving average currently at 577, as well as the interesting 38.2% Fibonacci and the big old 2011 to 2019 move at 618. Finally, the most recent and the one that was active until this week was the dark blue highlighted early October to date bear channel, currently at 497 to 549. We also have just above the market the bright red lower trendline extension, currently at 575, the big old November 23 to the April 24 descending triangle. That was support and is now resistance, possibly some principal resistance as well. Interestingly, the extension itself was due to a pattern I spoke about 11 weeks ago, when I said, and I quote, "During February through to April we saw the development of a rectangle pattern based on the 551 to 590 area. Please remember this area as it became relevant to more recent action." End of quote. This area was the origin of the original larger bear channel, which I'd previously mentioned right at the start. Anyway, we are now below the bright red trendline extension, but above the dark blue bear channel. I'd previously said 5 weeks ago, and I quote, "All this also still leaves 2 potential targets below. Primary target X at 531 and the secondary harder to reach target X1 down at 527. These are the targets that break below the middle bull channel, the late August to mid-October bull channel." End of quote. The market has had trouble stabilizing below the 551 to 590 congestion from the rectangle pattern, though we came very close last week below 535 to both target X and target X1. However, I have a suspicion that the moment for these targets may be over, and though I will keep them on for another week, I'm not too confident in them, especially when you bear in mind that they are at the 38.2% absolute Fibonacci line at 533 and the late August low at 527, which both of those will no doubt interfere with any moves lower. Last week I tried a new late May to very early October bearish shift pitchfork here today, with prices at this time being shepherded lower by the nearby overhead upper time, currently at 570. Now I'm not too sure about this bearish pitchfork for now, this bearish shift pitchfork now. It is still valid, though I keep a close eye on it. If it fails, then there is no fallback, it will simply be retired. And I have to cast my eye to see what other new patterns may emerge. Now I have an idea, but it's way too early to say what it is as yet. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Topic and ADM Investor Service International Limited. And here comes the final important bit.